The economy is sending mixed signals and people are feeling the strain. Inflation, market volatility, and job uncertainty are all making headlines. And of course, tariffs. But is this just a slowdown, or are we actually in a recession, the dreaded R word? Let's break it down with data, not just headlines. First of all, what is a recession anyway? We hear this word, but do we really know what it means? Well, the classic definition, economically speaking, is 2 consecutive quarters of negative GDP growth. But the reality is it's not always that simple. The National Bureau of Economic Research, which officially declares recessions, looks at a range of economic indicators, not just GDP. So what should we be watching? Well, here are the major markers that tell us if we're actually in a recession. Of course, GDP growth. Are we seeing 2 straight quarters of contraction, i.e. getting smaller? Unemployment rate, consumer spending. Are people pulling back on spending, especially big ticket items? Industrial production. Is manufacturing and production slowing down? And corporate earnings. Are businesses making less money and cutting costs? And of course, inflation versus interest rates. Is the Fed raising rates to fight inflation or slowing down the economy too much? So where do we stand right now? Let's look at the data. GDP growth, we obviously don't have data yet for Q1 2025, we're getting close, but we do know that Q4 2024 saw a decline in growth. So we see another drop in Q1, that would be a strong recessionary signal. This also coincides obviously with a significant shift in leadership. President Biden leaving office and President Trump taking over. They're vastly different economic policies, particularly regarding tariffs. The uncertainty alone is shaking markets. Now let's look at an unemployment rate. The change over time here, we are seeing some concerning trends. There are notable spikes in unemployment in mid-2024 and early 2025, with some relief in late 2024, but obviously that's seasonally employed. So rising unemployment, especially when sustained, is a recessionary signal. So that could mean that businesses are cutting back. Now let's talk about stock market volatility and investor sentiment. Of course, a 3-week market sell-off has intensified, with S&P dropping nearly 9% from its all-time high and the Nasdaq Composite falling nearly 14%. Now, this sell-off was largely driven by fears of recession, which is what we're talking about, with investors dumping high-growth tech stocks in favor of more defensive assets. Tesla saw a staggering 15% drop, while AI giants like Nvidia and Meta, they took pretty heavy hits too. So tech, viewed as a risk-on asset, if people are worried about recession, they're going to sell their risky assets. And investors are reacting strongly to tariff policy uncertainty, which has already led to downward revisions in growth forecasts from major firms like Goldman Sachs. Of course, we've got treasury yields and safe haven investments. They are a signal as well. The CBOE Volatility Index, or the VIX, measure of market fear, spiked to its highest level since December. And treasury yields declined as investors sought safer assets. And Bitcoin, despite its rampant tear up over $100,000, has dipped below 8,000, indicating a sign of risk of sentiment. So based on all of this, are we in a recession? Well, the GDP numbers suggest a slowdown, not a full-blown recession yet. Of course, rising unemployment in key months and the sharp sell-off in markets suggests that economic stress is building. Tariff policy uncertainty is playing a major role here. Treasury Secretary Bessent has even warned a potential detox period as government spending is cut. And in a recent interview, Trump himself described the economy as being in a period of transition, which isn't necessarily a confidence booster. So what does this mean for you and for me and anybody else that's an everyday person? What can you do, recession or not? Well, track the job market. If layoffs rise, it's a sign of trouble. Watch interest rates. Higher rates mean loans and mortgages get expensive, also bad times. And monitor market sentiment. A sharp decline in investor confidence can signal deeper economic trouble. And if you are able to, of course, build an emergency fund just in case the economy takes a dive. That's always a good strategy for anybody, anywhere. But obviously investing wisely is also key. Economic downturns can create buying opportunities if you play it smart, but it depends on your position and how you're feeling about things. But overall, the question remains, are we in a recession? Well, I think the data says maybe, but it's complicated. There's nuance and subtext. The best way to prepare, stay informed, watch key indicators, make smart financial decisions. And if you want more data-driven breakdowns like this, I'm happy to make more videos on the subject. And I hope you enjoyed watching this video. Thanks for watching, and I'll see you in the next one.